What is a balance sheet? Have you ever wondered what all the fuss is about? We find a lot of business owners don't really understand a balance sheet or why they're produced. My name is Kim Marler and I'm the MD of Krystal Clear Accounting, and in this video I'll explain all. A balance sheet is in effect a snapshot of a company's financial health and performance at a point in time, usually produced at its year end. If your year end date is the 31st of December, then that's the date that it is produced, and it will show the value of everything at that point. So let's look at what it actually shows. The top of the balance sheet shows all the fixed assets of a business. This could be actual physical assets like premises, plant and machinery, which is valued using a generally accepted accounting principle, and there are often notes in the external annual statutory accounts showing how these figures have been arrived at and what depreciation charges have been applied. Depreciation is a notional charge which is used to show a fair value of what a second-hand asset is worth if you were to buy it in. It is worth noting though that this might not be what you expected or what you could actually buy that second-hand asset for. There could also be intangible fixed assets, for example, goodwill. This is a subjective valuation based on a certain metric and is used to take account of the trading history that a business has built up over the years. It's worth noting that this is very difficult to actually quantify, and hence it's called an intangible asset. Current assets is the next section. Here are all the assets of the business valued at a point in time, which typically a business would be looking to convert into cash at some point. This could include a valuation of all the stocks in the business, if there are any. If you're a business that manufactures a product, then you will have raw materials, work in progress, and finished goods stocks ready for sale, but haven't yet been sold to a customer. If you're a service provider, like a website designer, you would have a website that's in production and partially finished, so it would have a value as it's work in progress, but it isn't yet fully finished and delivered to the client, and therefore you haven't had the cash. It would also include all the trade debtors or people who owe you money that haven't paid your sales invoices by the year end, but are liable to pay as there's no issue about non-payment. Often in current assets is cash in the bank at that date and any other receivables owing to the company. You would add up the current assets and add to the value of the fixed assets above to get a figure for the total assets owned by the company. The next section is all the liabilities. So this again is split into current and non-current liabilities. Examples of current liabilities would be monies owed to your trade creditors or suppliers, which are due but you haven't yet paid over. It's highly likely that this could also include any taxes not yet paid but due to HMRC, whether for corporation tax, VAT or PAYE. For non-current liabilities, or often known as creditors falling due after more than 1 year, this would be any long-term borrowings like bank loans or funding circle type lenders. You may have lease liabilities or hire purchase agreements. Again, all these liabilities, both short and long term, would be totalled up. You would then show your total net assets less your total liabilities, and hopefully this would be positive. The final section is more commonly known as shareholders' capital and reserves, or sometimes called equity attributable to shareholders. This tends to be the called up share capital and any share premium account, if there is any. The called up share capital is usually a small amount, like £1. Then there is also retained reserves, which are any profits from previous years, since the company began trading, that have been carried forward and not distributed as a dividend. The retained earnings focuses on the financial strength of the business, how much profit has been left in the business. Ideally, you want this number to be going up each year. Financial lenders look at this to assess credit worthiness, and be looking for evidence of retained earnings increasing year on year. This figure should balance to the net assets figure above. If it doesn't, there's an error. If you'd like to have a chat over a coffee, virtually or face-to-face, and to see what's possible, all you need to do is call me or one of my team on 0161 410 0020 or email wecare@krystal-clear.co.uk. I hope that's helped. Please subscribe to our YouTube channel so you don't miss any of the content that we release. Feel free to like and share. And thanks for watching.